Hello, everyone. I hope you're all doing well. Welcome to another session of F1 Business Technology here at KnS. I'm your tutor, Sir Asim Iqbal. So, if you guys can remember, and before you can remember, I really hope that you guys have been revising your concepts and practicing the questions from your kit because that's extremely important. The regular revision and practice is the key of passing this exam. So in the last class, as we discussed that the last point that we were discussing before we ended the last session was the initial steps or the overall steps a government takes in order to reduce unemployment and create jobs, right? We discussed all of these points in the last class. So let's move on to another concept, which is economic growth. Now, if I am to summarize economic growth for you guys, it's like how much a country can produce as a whole, how much output, how many goods and services a country can produce as a whole, right? So the more you are able to produce and the more variety of goods and services that you are specializing in, that you are producing, the more you are set to experience economic growth, okay? We have basically two types of economic growth here. We have actual economic growth and potential economic growth. Actual economic growth is your economic growth or your output right now at this very moment, right? Like how much you're producing, how much you're manufacturing right now, okay? And the potential economic growth is when all of your factors of production and all of your resources were utilized, and the economic growth you'll be able to experience because of that, right? Because you guys might have heard the phrase that you're not utilizing your full potential, right? So it goes the same for a country. Like a country is not realizing its full potential. It has the resources, it has the manpower, it has the technology, but it's not fully utilizing them, and thus it's not able to achieve the economic growth that it can, right? All it needs is to utilize the resources it already has, and it can reach its potential economic growth. Okay, let's move on. Actual growth in the long run is determined by two factors. Okay, what two factors are those? Those two factors are the growth in potential output and the growth in aggregate demand. Meaning, how much you are able to supply means how much you are able to produce, and how many of the goods that you're producing will actually be sold, will actually be demanded by the other people, right? Because if you're just producing the goods and nobody is buying them, so like there's not actually a growth over there, right? If you're making something, there should be buyers for those goods as well, right? The causes of growth in potential output are the determinants of the capacity of the economy rather than actual spending, and are as follows, okay? What this point means, I'll come to it in just a bit. Okay. What this point basically means is that we have to utilize all of the factors of production available to us. We have four factors of production. If you have not discussed them earlier, I'm telling you right now. The four factors of production that we have is land, labor, capital, and entrepreneurship, right? Entrepreneurship is the leadership, the management, which combines all of the other factors of production like land, labor, and capital, and turns it into a business. Right, turns it into an enterprise. Okay, so when you want growth in the economy, you have to identify what and how much of the factors of production are available in your country. Okay, utilize them, create the supply, and identify the demand and fulfill the demand by using your supply. Right, so that's basically how economic growth actually occurs. Let's move ahead. Then we have sustained economic growth. What is sustained economic growth? Let's give it a quick read, then we can understand it. Quite simple. Sustained economic growth depends heavily on adequate level of new investment, which will be undertaken if there are expectations of future growth in demand. The rate of extraction of natural resources will also impose a limit on the rate of growth. This is the main point, right? Because if you are like crazy about economic growth, you're just producing, and you don't care about the environment, right? Because there's a saying in economics that if you cut a tree, you have to plant 2 trees, right? Like if you're cutting down a tree for your own purposes, whatever it may be, like for construction, for furniture, for whatever, right? So if you are cutting down 1 tree, you have to plant 2 or 3 trees, okay, in order to replace that tree, okay? So if you don't do that, if your economic growth is not sustainable, you are consuming your natural resources way faster than you can replace them, then your economic growth will not be sustainable. Okay, your economy is probably going to crash in the years to come, right? Technological progress can be divided into 3 types. Okay, what those 3 types are? We have capital, labor, and neutral. Okay, what these things are, basically just a straightforward definition. Let's quickly go through them. Technical advances in capital saving that use less capital and same amount of labor. Labor saving is using less labor and same amount of capital. And neutral is using equal amounts of labor and capital. Like for example, it's more like labor intensive and capital intensive, right? Like take the example of a small business. A small business will probably be more labor incentive, right? Because a small business cannot afford to employ high-tech machinery or equipment, okay? So they'll be mostly working through the human beings, right? Like people will be employed more rather than equipment. But for a car manufacturer like Toyota or Honda, you will see big time and very sophisticated robots doing all the manufacturing, most of the manufacturing, right? So capital intensive are all those industries which employ a high level of capital, high level of sophisticated machinery to get the job done, and less people. And labor intensive are all those companies which employ more human labor, human workers as compared to the equipment. And neutral is like 50-50. Right? Equal amount of capital, equal amount of labor. I hope that's clear. Let's move on. Some disadvantages of economic growth. Now, this is an interesting concept because if you are experiencing economic growth, like your people are getting employed, your output is increasing, the incomes are rising, unemployment is falling. So, what exactly is the problem here? Well, there are very, very few things in the world which have either all disadvantages or all advantages, right? And economic growth is not an exception. Let's take a look at the disadvantages of economic growth. As we discussed earlier, that if you're cutting down 1 tree, you have to plant 2 trees, right? If you are experiencing a high level of economic growth, you must keep in mind that you have to utilize natural resources to do so. And many of those natural resources are not that easy to replace. The oil that you're using, right? It took like hundreds and millions of years to form. And once the oil runs out, good luck finding another source of energy, right? That's why the world is so much focused right now on renewable energy, like solar, wind, and hydroelectric power. Pollution, as we discussed earlier, right? Because if you are increasing your supply, you are increasing your growth at an unprecedented scale, there's a high level of chance that there's going to be a lot of pollution, right? You're creating a lot of waste, okay? And that waste can really damage the environment, okay? Then there's going to be structural unemployment due to technology. If you want to experience higher economic growth, you want to increase your supply drastically, you're going to have to use advanced machinery. And that advanced machinery is going to replace those workers, is going to replace those manual workers, right? And that's going to cause structural unemployment and all the problems that come with it. Okay. Now, what's going to happen in the last point, that many investors are going to come. People are going to say, hey, listen, it's a period of growth, right? Our economy is growing. So rather than spending all of our money, let's save it or let's invest it, okay? So there's going to be higher investments, higher savings. So if people are saving more money, they're going to be spending less money. And if they're spending less money, it means that whatever you're selling, it's not going to be bought up by the people, right? Because they're saving their money, they're not spending it. Okay? So overall demand and productivity will fall because of it. Okay. I hope that's clear. Let's go ahead. The four main objectives of economic policy. Whenever we talk about economic policy, we have four things to deal with. We have four objectives of economic policy. Okay? And let me tell you guys that achieving all four of them is practically impossible. You can achieve two, maybe three of them at a time, but the fourth one you will have to compromise on. Okay? What those four objectives are: to achieve economic growth, to control price inflation means reduce the inflation, reduce the prices, achieve full employment of the people, and to achieve a balance between exports and imports. Right? Means you have to control your exports and your imports, preferably more exports and less imports, right? Okay. Let's see how we can manage these four objectives. Okay. But before we do, the government will intervene. And how the government intervenes, like whatever decision you're making, okay, whatever decision a company is making, the government has a stake in it, whether you like it or not. Since most of us are living in a mixed economic government, in a mixed economic system, so the government has a say in all of our decisions, right? Okay. When we want to increase our output capacity, whether we want to change our output capacity, the government can give us grants or tax incentives to, increase. Whenever we have competition, the government, what it can do is like it can allow others to come in. It can block other people, block other competitors from coming in, or create laws to encourage healthy competition. Whenever there are monopolies are all those companies which are supplying, like who are the sole suppliers of a particular product or service in the whole economy, right? And they're very giant entities usually. So when there are monopolies, the government will pass laws, the government will take steps to break them up so that other people can come in and other competitors can come in, and there can be variety of the people to choose from. Okay. Then we have sales demand. Well, this is not usually, I would say, an effective intervention, but what the government can say, like, for example, if you're producing merit goods, so the government can encourage you, the government can help you increase the demand of that product, and whenever you're selling demerit goods like cigarettes, so the government can take steps to discourage that. Like for example, whenever you see in movies, sometimes, right, you're watching a movie or you're watching a series, and like there's a guy who is drinking alcohol or he's smoking a cigar, right? So you see at the bottom, smoking kills, right? Or consumption of alcohol is dangerous. Okay. So this is a step taken by the government to influence demand. Okay. Government influence over operational decisions. Now it's a pretty straightforward thing. For health and safety, employment, consumer protection, and taxation, they basically pass different kinds of laws. Okay? Different laws for health and safety, for employment opportunities, for consumer protection, and to collect tax. Okay? All right. Now, basically, there are two policies when it comes to government intervention. There's fiscal policy and then there is monetary policy. Right? We'll come to monetary policy in just a little bit. Fiscal policy is government policy on taxation, public borrowing, and public spending. Right? Now, what exactly does fiscal policy entail? Fiscal policy entails these three things: expenditure, revenues, and borrowing. How a government is able to influence demand and supply in the economy, right? How a government is able to influence supply and demand in the economy, it can either be done through fiscal policy, it can be done through monetary policy, or it can be done by a combination of both. How? Let's take a look. There are three components of the fiscal policy. Expenditure. Let's take a look at the first one. The government at a national and local level spends money to provide goods and services such as health service, public education, police force, roads, public buildings, etc., and to pay its administrative workforce, means the people in the public sector, right? Their salaries, bonuses, all that stuff. It can provide finance to encourage investment by private industry. Now, what is happening over here? That government has expenditures, right? The government needs money to pay for its workers, all of the people in the public sector, and to provide the basic infrastructure and the basic benefits like healthcare and the police force and your whole infrastructure. Okay, all these things, they cost money. Okay, so the government with fiscal policy plans the expenditure of your resources, right? Of all the money that it has. And how does the government get that money? Expenditure must be financed and the government must have income. Most government income comes from taxation, although some income is obtained from other charges. Now, as we discussed earlier, that the main source of funding for the government is through taxes, right? Whether it's income tax, it's sales tax, it's VAT, it's corporation tax, it's capital gains tax. No wonder that the government imposes so many taxes on you guys, right? Well, it can vary from country to country, but usually what happens is government taxes almost every aspect of your life. You live, you pay tax. You die, you pay tax. You buy something, you pay tax. You sell something, you pay tax, right? You earn something, you pay tax, okay? So each and every aspect of your life is governed by taxation because the government needs money from you, okay? All right. Although taxation serves as a major investment or as a major collection tool, financing tool of the government, there are other ways, there are other means in which a government can invest to take the money. One major, I would say, tool for doing so is public borrowing. You might have heard of the term treasury certificates, right? Or treasury bonds or government bonds, okay? Now, what exactly does that bond entail? It's basically a promise by the government to pay you back with interest after a certain period of time. Like, for example, a $1,000 bond with a 10% interest and a repayment time of maybe like 4 years, right? So the government is saying, hey, listen, you give me $1,000, okay? You purchase this bond for $1,000. I get $1,000 from you. I'll pay you 10% interest over the years for 4 years, and after 4 years, I'll return the $1,000 to you, right? So this is a tool used by the government. It's basically called public borrowing, right? A same approach is done by the companies, the PLCs, the public limited companies. That is called debentures. Okay, so what's debentures for a public limited company? It's called public borrowing for the government, right? I hope that's clear. Let's move on. If a government decides to use fiscal policy to influence demand in the economy, it can choose either expenditure changes or tax changes. Like if a government really wants the fiscal policy to work, it has to either revise the expenditure, how much it's spending, or how much it's collecting, right? Either change your expenditure, either control your expenditure or control your taxes, right? Both of them cannot work at the same time, right? Because if you're expecting very high changes in tax, like if you're charging a high amount of tax and you are not providing as much sources, as much benefits to the people, then there's going to be a failure of fiscal policy. Okay. Let's take a quick read at this. It can increase demand directly by spending more on itself, like we discussed earlier, that if a government provides the public with the infrastructure, with the good health benefits and unemployment benefits and everything a person needs to survive, then the demand will actually increase. It's actually going to positively affect your economic growth because people will be in a better position. Okay, if you are able to travel safely, like if you're able to travel cheaply, conveniently, and you have money in your pocket due to all of the money that you saved from health benefits, right? So you can use that money to buy other products, and ultimately that's going to lead to economic growth, right? Okay. This extra spending could be financed by higher taxes, but would reduce the spending by the private sector. Obviously, just like we discussed earlier, just a few minutes ago, that you have to control the taxes or you have to control the expenditure. By you, I mean the government. Okay, all right. The extra government spending could also be financed by government borrowing or public borrowing that we discussed. The government can either influence your demand directly by higher taxes, higher spending, or by public borrowing, and it can also affect your demand indirectly. How? It can basically provide you with alternatives. Okay? It can provide the companies with tax cuts. Right? Like what it does is, like, instead of targeting the consumer, the end consumer, what the government can do is, like, it can offer tax incentives to the companies, right? Like the corporate taxation. Like let's say the companies are paying 20% tax, the businesses are paying 20% tax flat, right? The government says, hey, listen, we are not going to charge you so much tax right now. Instead of 20%, you guys can pay 17% tax. Okay? So the cost of the company goes down, right? At first, the company was paying 20% tax, now it's paying 17% tax. So the cost of the company comes down, and as the cost of the company comes down, the prices will also come down, right? High cost, high price, low cost, low price. And low price will lead to increased demand, right? So this is an indirect way which a government can intervene. Okay, let's move ahead. Let's see some functions a taxation has. Although we've covered many of these points, but let's take a look in case we've missed any of them. Okay, to raise revenues for the government, yes, we've discussed that to a great extent. To cause certain products to be priced into the account, like to cause certain products to be priced to take into account their social costs, like demerit goods is discouraged by the government, vice versa, public goods or merit goods are encouraged by the government. To redistribute income and wealth, what the government does is usually it taxes rich people a lot higher as compared to the poor people, right? Like it takes more tax money from the rich and very less or almost no tax from the poor communities. And what they do is they use the high amount of tax from the rich people and they invest it, they help the poor people. So the government sort of acts like a legal Robin Hood. Okay? And protect industries from foreign competition. We discussed imports, right? Imports bad, exports good. Okay? So the government can impose tariffs. Tariffs are basically high taxes on imports. The more expensive your imports are, the more your people will resort to purchasing local goods rather than importing foreign goods. Okay? Let's move ahead. A direct tax and an indirect tax. Okay? Now these two are the main methods through which a government collects tax. A direct tax is a tax which is paid directly to the government. Like for example, whenever you get your paycheck, like let's say if you're being paid $10,000 a month, okay? If you're being paid $10,000 a month, you are not taking those $10,000 home, okay? The government's gonna come in and the government's gonna take maybe like 25%, 30% of it as tax, okay? that tax is going to be deducted at source, okay? Either by the government or by the employer to give to the government, right? So all the money that is deducted, and in major forms, like on your income, all the income that you pay on your salary, all the income that the businesses pay on their profits, if you sell something at a higher price, so the tax you pay on the profit, that's called capital gains tax, right? And like, if someone passes away, unfortunately, and they pass something to you, okay? You inherit something from someone, so you have to pay tax on that as well, okay? That's called inheritance tax. So these are all the taxes. It can be on income, it can be on profit, it can, it can be on wealth. All of these taxes are called direct taxes. Okay, they're usually progressive in nature. Most of them are progressive in nature, especially your income tax. Okay, income tax is mostly progressive in nature, whereas corporation, capital, and inheritance tax are mostly proportional, because they usually have a flat rate of tax. Okay, all of these concepts, all of these taxation, you guys will be studying in great detail in F6. We have an amazing teacher over here, Sir Ramiza Ryan, and through him, you guys can experience an amazing outlook on all of this taxation issues. And it's not that difficult. Like, it's a quite interesting subject, to be very honest, and quite lucrative as well, right? Like, if you study UK tax and you're working in the UK, so this information and this expertise can really help you out. Like, it's a very lucrative field. Okay. Anyways, indirect tax. Now, indirect tax is paid by everyone. It's usually in proportional or regressive in nature, right? Like, let's say you go to a supermarket. Anyone goes to a supermarket. Like, a billionaire goes into a supermarket, and like a normal guy, right? Like a middle income person or a low income person, both of them go into a supermarket, and they buy a packet of ramen noodles, right? So that packet of ramen noodles is like, maybe let's say $5. Okay? So that $5 ramen noodles is going to be the same for the billionaire, it's going to be same for the poor person, right? Both of them are paying the same price, both of them are paying the same tax on that packet of ramen noodles, right? So indirect taxes are all those taxes usually set in the prices of all the goods and services, right? Everything that you buy in the supermarkets, mostly they have VAT, sales tax, or GST attached to them, okay? And it's proportional for everybody. Everybody is paying the same amount of tax, okay? Let's move ahead. Specific tax and ad valorem tax. A specific tax and ad valorem tax, the main difference between them is specific tax is like a specific number, right? Like, if you're buying something worth $30, so $5 is tax. Okay, it's not a percentage of the price. Specific tax is not a percentage of the price, it's a fixed amount, like $5 tax. Okay, and ad valorem tax is a percentage, like 5%. So no matter how much the price changes, it's going to be a fixed percentage, right? Like if the product today is $30, so 6% of $30 is sales tax or indirect tax. But if the price changes to maybe like $50 tomorrow, so it's going to be 60%. So it's going to be 6% of $50, right? But in specific tax, it's just going to be $5 no matter what the price is. Okay, guys, let's move on. Now, we use terms like progressive, regressive, and proportional taxation. What it basically means, a progressive tax means low tax or no tax for the poor and high taxes for the rich, right? Regressive tax means the opposite, high tax for the poor and low taxes for the rich. And proportional tax means everyone pays the same tax no matter how much you're earning. Okay, simple as that. Okay. Let's move ahead. Monetary policy. Let's move ahead. Monetary policy. Using money supply and interest rates to influence demand. Fiscal policy was using government spending, government borrowing, and taxation to influence demand. Monetary policy uses money supply and interest rates to influence demand. Okay? Now, there are slight problems in monetary policy. Like, interest rates, they're very, I would say, they're very haphazard, so to speak. Okay, they're not predictable. Okay? Because interest rates are usually what, the terminology we use, a floating charge, right? Floating charge means it's affected by the market forces. Interest rates are usually affected by market forces. Governments do have some control over them, but not entirely. Okay, so if interest rates are not predictable, so monetary policy may not be as effective. Okay, and if you are increasing money supply in the market, and if you're decreasing money supply in the market, there's going to be some time before we see the actual impact of that policy. Okay, because if the government cuts taxation or if the government increases taxation, you will see an immediate effect on the economy, right? But in monetary policy, whether you reduce the money supply or the government increases the money supply, there's going to be some time before the government can see the results of their policy. Okay, let's go ahead. Interest rates as a target for monetary policy. Let's talk a little bit about interest rates. Okay. A rise in interest rates will raise the price of borrowing in the internal economy for both companies and individuals. Obviously, if it's going to rise, if the interest rates are going to rise, taking loans and borrowing for both the people and the companies is going to be much more expensive because they'll have to pay a higher interest on those loans, right? If companies see the rise as relatively permanent, means if interest rates have increased and there's almost no chance of those interest rates coming down, then what's going to happen? Rates of return on investments will become less attractive and any investment plans may be curtailed or delayed. Okay, now, whenever you're investing, interest rates are a big element, a big decision-making factor for everyone who's planning to invest. Because most investments, they require borrowing. Okay, if you're investing to maybe construct a business or a building or a plaza, anything like that, you are going to need loans. Okay, and if interest rates are high, that's going to discourage you. Okay. I mean, yes, people like investment companies who just want to earn interest, it's going to be good for them. They can just put their money in the bank and earn the interest, right? But for the other types of investment, it's not going to be that lucrative. Okay, let's move ahead. Corporate profits will fall as a result of higher interest payments. Obviously, companies will reduce inventory levels as the cost of having money tied up in inventory rises. Individuals should be expected to reduce consumption or postpone their consumption in order to reduce borrowing and will become less willing to borrow for house purchases. Means the ultimate demand will fall. In short, for both the companies will cut down their supply and the people will cut down their demand. Okay, it's going to become more expensive for the companies to pay off their loans. Okay, and often their warehouses, their buildings, their equipment, they're usually on mortgage. Okay, so a higher level of mortgage payments and the interest on them is going to discourage them from making more and more products, right? Because it's going to be more expensive for them. So what they're going to do, they are going to either sell off the warehouse and sell off all the inventory in their stock. Okay, and what the people are going to do is that people are most probably they're going to move to rented living. Right? They're going to say, hey, listen, mortgage payments are becoming way too expensive. I think it's better that we sell the house, we let go of the house, and we, move into like maybe a rented apartment or something like that. Okay, I hope that's clear. High interest rates will keep the value of sterling or any currency that you're having, will keep the value of sterling higher than it would otherwise be. This will keep the cost of exports high and discourage the purchase of exports. This may be necessary to protect the balance of payments and prevent import cost push inflation. Now, how are high interest rates going to discourage your exports? Guys, it's very, very simple. If making local supplies becomes more expensive, right? If high interest rates will cause your local production to become more expensive. If local production becomes more expensive, your exports are going to become more expensive. Like all the goods that you're making and selling to other countries, that's going to become more expensive, right? And thus the exports will be, it's going to become more and more discouraged, so to speak. And people will say, hey, listen, instead of, like we have a shortage of goods now, and the local goods are becoming more and more expensive, so it's better that we get those goods at a cheaper rate from abroad. Okay. High interest rates will attract foreigners in sterling investments to provide capital and help to finance the balance of payments deficit. In short, what it means is that people or investment companies who are only interested in earning through interest, it's going to be good mostly for these guys only. Okay. Like what these guys will do is that they'll put all of their investment into the dollar or into the pound or whatever currency is having a high interest rate. Okay, like for example, I see that the US has a very high interest rate. Okay, so I will invest all of my money into dollars within a US bank, so I can earn a higher rate of interest on that money, on that currency. Okay, I hope that's clear. Let's move ahead. The exchange rate, the target of monetary policy. Okay, now the exchange rate. Before we move on to the exchange rate, I'm just going to tell you what this whole concept is all about. It's usually about your currency versus other currencies, okay, and the imports and exports that are associated with them. Now, let's say the terminologies which are used for increase and decrease of currencies is called appreciation and depreciation of a currency. Appreciation means your currency is becoming stronger, and depreciation means your currency is becoming weaker. Okay, like for example, if we compare the US dollar with the Indian rupee, okay, we have the US dollar and the Indian rupee. Okay, let's say 1 US dollar equals to 100 Indian rupees. Okay, 1 US dollar equals to 100 Indian rupees. Means the Indian rupee is comparatively weaker as compared to the US dollar. Okay, so what's that going to mean? It means that people from India, they can sell their goods to US, they can export their goods to US, and it's going to be very beneficial for them, right? It's going to be very beneficial for them because they'll be earning in dollars. Okay, they'll be earning in dollars, and since the dollar is a very advanced currency, so it's going to be very beneficial for the suppliers. However, the imports are going to be damaged because if India wants to buy something from the US, it's going to be very expensive for India to do so, right? Now, let's talk about appreciation and depreciation. Again, 1 US dollar equals to 100 Indian rupees. Okay? Now, depreciation. 1 US dollar and 140 Indian rupees means the value of the dollar has risen, the dollar has appreciated, but the Indian rupee has depreciated, right? So now it is going to be even better for the exporter because now they can sell their goods for 140 rupees, right? They can sell their goods at 140 rupees, right? And thus they're earning more profits now. But for the purchasers, for the importers, it is going to be more expensive because Before they were buying goods at 100 rupees from the US, now they'll be buying goods at a much more advanced price of 140 rupees. Okay? So whenever your currency depreciates, whenever your country's currency depreciates, the exports become cheaper, the exports usually increase, and your imports decrease, your imports become more and more expensive. And vice versa. And vice versa, 1 US dollar, 100 Indian rupees. 1 US dollar, 100 Indian rupees. Next year, what happens? 1 US dollar, 80 Indian rupees. Okay, 1 US dollar and 80 Indian rupees. Now, what's going to happen, guys? The exports will be discouraged. People will say, hey, listen, the exports, they're earning us less money now. Okay? At first, we were getting 100 rupees for everything we sold. Now we're getting 80 rupees. So exports will be discouraged when your currency appreciates. But importers are going to be very happy. Why? Because first they were able to buy things from US at 100 rupees. Now they are able to buy them at a cheaper price of 80 rupees, right? So the appreciation of your currency will result in lower exports and higher imports. I hope that's clear, guys. Let's give it a quick read to complete the formality, so to speak. If the exchange rate falls, exports become cheaper to overseas buyers and so more competitive in export markets, and imports become more expensive. Okay? A fall in the exchange rate, might be good for a domestic economy by stimulating exports and reducing demand for imports, right? Just what we discussed earlier. And the vice versa in the second paragraph, okay? That an increase in exchange rate will have the opposite effect. Let's move ahead. An economic indicator. What does that exactly entail? We have basically three types of economic indicators. We have leading indicator, we have coincident indicator, and we have a lagging indicator. Okay. Most of them, I would say, they are very closely linked to the economic cycle or the business cycle. You know, the growth, boom, recession, and slump. So, since these indicators are very, very closely tied to the economic cycle, the leading indicator, what it does, it gives a future prediction. Okay, it gives a future prediction of what's going to happen because of what's happening right now. Like, for example, if today you are increasing your interest rates and today you are at a growth stage, for example, okay, so a leading indicator will tell you that what's going to happen because of this when the economy reaches the boom period. Okay, what's going to happen because of what you're doing now, what's going to happen in the future. Okay, a coincident indicator, what it does, it is going to tell you that what's going to happen immediately. Okay, like if you are in a growth stage and if you increase taxation, for example, okay, you use the fiscal policy and you increase taxes, what's going to be the immediate effect of that policy? Okay, so that's called the coincident indicator, that what you are doing now and what's going to happen right now because of it, right? And a lagging indicator, well, it's not really used anyway. It's basically used to indicate past trends. Okay, like what has happened in the past. It basically collects past information, and we can use that to predict coincident and leading indicators, right? Okay, let's move ahead. Now, there are different ways of keeping tabs on how effective your monetary policy is going to be. Those tabs include, or those monetary indicators, they include the size of the money stock, or how much money is circulating in the economy, how much money supply is currently in the economy, the interest rates, the exchange rates, how much the government has borrowed through treasury bonds and through government bonds and through other countries as well, and institutions like IMF, World Bank, etc., and how much your economic growth is versus how much you have borrowed, right? Ideally, your GDP, your economic growth should be higher, much higher as compared to your government borrowing. Because if your economic growth is higher than your borrowing, it means you're easily able to repay all the loans, right? But in case of the opposite, okay, in case the opposite thing But vice versa is not an acceptable situation. Like if you have a high government borrowing and low GDP, low economic growth, then that's going to be a problem, right? Because it's going to be more difficult for the government to pay off the borrowing. Let's move ahead. Monetary policy can be made to act as a subsidiary support to fiscal policy. As I said earlier, that fiscal and monetary policy, both of them can be used interchangeably or together in order to cater to the economical demands. How would that work? Let's take a look. A policy of low interest rates or absence of any form of credit control might stimulate bank lending, which would increase expenditure in the economy. High interest rates will reduce the spending in the economy, and strict credit controls might be introduced to reduce lending and demand in the economy. Meaning, like if you have low interest rates, for example, right? Like if you have low interest rates and if you want to increase your demand, right? So low interest rates will automatically increase your demand, and when your demand increases, the government will have more money through taxation, right? So these are the ways. If you want to take another example, like let's say if you want the people to reduce their demand, monetary and fiscal policy can work in ways that you can increase the interest rates and you can increase the taxes as well. Okay, so higher interest rate and higher taxes will eventually lead to a reduced demand. Okay, so this is how both of these tools can be used together or interchangeably in order to influence demand. Okay, let's move ahead. Balance of payments. Basically, your exports versus your imports. Okay. The balance of payments consists of a current account with visible and invisible sections and transactions, such as your capital and your financial account. Balance of payments. The balance of payments accounts consist of a current account and a financial account. Okay. Now, what do these things entail? Basically, it's all about your imports versus your exports, right? But we have two additional accounts to consider when it comes to balance of payments. One of them is the capital account, which is made up of public sector flows of capital, such as government loans to other countries. And then we have the financial account, which is made up of flows of capital to and from the non-governmental sector. Meaning, the capital account is the government account of imports and exports. Okay? The capital account is the government account, the public account of imports, exports, and loans. Right? And the financial account are all the investments and all the loans that have been undertaken by the private sector. All the loans and the investments done by the private sector and taken from the private sector of a country. Okay? Let's move ahead. A surplus or deficit on balance of payments usually means a surplus or deficit on the current account. Current account is what separates imports and exports. If you have higher imports and lower exports, you are going to face a deficit of current account, and vice versa, you're going to have a surplus. Okay? So, what can it do if it has a deficit? It may borrow more from abroad and build up external liabilities. Like if you have a deficit in your current account, you can take loans, which can in the long run, if you don't pay them off, it can further damage your current account, and it can sell more of its assets, right? If you sell more of your assets, like more of your capital equipment, more of your factories, then you might have the money to pay off the current account deficit. Okay. How can a government rectify a current account deficit? Now, the best way to do that is to increase your exports. How can a government rectify a current account deficit? The best way to do it, guys, is to do it through a higher amount of exports. The more exports, the more money into the economy, right? And if you want to encourage exports, what you have to do is you have to depreciate your currency. Okay? A low currency, a weaker currency will result in higher exports. You can restrict your imports, right? If you depreciate your currency, it's going to encourage your exports and discourage your imports. And domestic deflation, reduce your prices. Okay, reduce the prices, reduce the inflation, so the local supply becomes cheaper to manufacture and to sell, right? So you're able to compete more effectively in the international market. And here, guys, is where we finish our third chapter, and then we move on to the questions. After that, it will be officially complete. Just a few questions, guys. Bear with me on this, and let's get them done. Okay? Okay, the first question. Which of the following is not an element of fiscal policy? A very straightforward question. Which of the following is not an element of fiscal policy? Yes, you're right. It's exchange rates. Government spending, borrowing, and taxation are all part of fiscal policy. Exchange rates are usually a part of monetary policy. Good work. Let's go ahead. Okay, which taxes are collected by the Revenue Authority from a business which attempts to pass on the tax to consumers on the price of goods? Okay, now which taxes are collected by the government and they are passed on to the consumers? Is it progressive tax, direct tax, or indirect tax? I'll give you a hint. Sales tax. Now, sales tax is a sort of indirect tax, right? Okay, let's go ahead. If a government has a macroeconomic policy objective of expanding the overall level of economic activity, which of the following measures would not be consistent with such an objective? Okay, like if you want to expand your economic growth, you want to increase your economic growth, which of the following would not help it? Increasing public expenditure? I don't think so. Lowering interest rates? No. Increasing taxation? Yes, I think this could be the answer. And yes, it is the answer. Because if you increase taxes, both the companies will reduce their supply, the consumers will reduce their demand, and your economic growth will slow down, right? Good work. Let's move ahead. The currency in country X is the krone, while the country Y uses euro. Okay? Country Y has recently experienced an increase in exchange rate with country X. Okay. Which of the following effects would result in country Y? A stimulus to exports in country Y, meaning an increase in exports to country Y, an increase in cost of imports from country X, reduced demand of imports from country X, or a reduction in the rate of cost push inflation. Now, this is an interesting question, guys. I want you to break down this question. Break them down into different sentences. Okay, analyze each sentence carefully, read the answers, and then tell it to me. I'm going to give you guys 2 minutes to come up with the answer. So, what is it? Is it A? Is it B? Is it C? Or is it D? The answer, my friends, is D. A reduction in cost push inflation. Now, I want you guys to read the description. Okay? An increase in exchange rate, right? Because a country Y has experienced an appreciation of currency, right? So, an increase in the exchange rate makes a country's exports more expensive and imports cheaper. Okay? So, exports are more expensive and imports are cheaper. So, first three options are automatically nullified. Okay? The lower cost of imports is likely to reduce the rate of domestic inflation. Okay? Since your imports are now cheaper, the imported inflation is also cheaper. Let's move ahead. All of the following, except one, are protectionist measures in international trades. Which is the exception? Like, you are protecting yourself, you are protecting your company, you're protecting your country against expensive imports, right? Which of the following is not such measure? Which of the following is not like which of the following is not such a protectionist measure? Quotas, subsidies, customs, or tariffs? I think you guys might have figured this one out. Yes, it is subsidies. Okay? Because all of the protectionist measures, they're usually offensive in nature. Okay? Offensive, or I would say attacking nature, right? Because like it is subsidies, right? Because when you are providing subsidies, you are actually helping your own people. Okay, you're not bothering anyone else, right? Through import quotas and custom procedures and through tariffs, these are going to create problems in the international trade, and other countries might retaliate, right? But if you're helping your own consumers, if you're helping your own suppliers, you are helping your own exporters, it does not mean that you're attacking anyone. Okay, so there's a very less risk of retaliation from the other entities, from the other countries. Which of the following statements is true or false? Frictional unemployment will be short term, and governments can encourage labor mobility. I hope you guys can remember what mobility means. If they want to reduce unemployment. Guys, I'm thinking both of them might be true. And yes, they are. Okay. Frictional unemployment occurs when there is difficulty in matching workers quickly with jobs, meaning frictional unemployment applies to those people who are, they say they're in between jobs, right? Like they're actively searching for a job. Okay, they're not just relying on unemployment benefits, or they're not been laid off permanently. They still have a lot to offer. They're still actively searching for a job, and sooner or later they will get those jobs, right? So frictional unemployment is usually short term, and yes, the government can take measures to help with labor mobility. Okay, they can help them in transportation. They can help them in reduced, shifting costs. Okay, relocating costs, and with accommodations, all of that stuff, retraining programs, all of these measures can be taken by the government to reduce unemployment by increasing or encouraging labor mobility. Let's move ahead. Which two of the following does the government economic monetary policy relate to? Okay, guys, that's pretty easy. Pretty easy. And yes, you are right, interest and exchange rates. Okay, a little trickier one. Which three of the following are goals of a macroeconomic policy? Now, just by reading the word three, you guys might have gotten a bit panicked, right? Don't be, it's an extremely easy question, just like this one. Okay, take a look. Remember the 4 economic policies. You have to find 3 of them amongst these 5 options. Which one is it? I think you guys might have identified 2 of them. The third one might be a bit tricky. A, B, and C. Yes, encouraging economic growth and low unemployment, that was like a no-brainer, right? Achieving zero inflation is not possible. There is always going to be some inflation. Okay, that is literally not possible. Okay, and low unemployment. We always try for low unemployment because there can never be zero inflation, there can never be zero unemployment. Okay, so economic growth encouragement, that's an objective. Low unemployment, that is achievable. Balance of exports and imports, yes, that is also possible. But there is no way of maximizing your foreign currency value, and there is no way of achieving zero inflation. Okay, so these objectives are fairy tales at best. Let's move ahead. Which of the following is an example of cyclical unemployment? Okay, guys, I really hope you remember that. Guys, I really hope you remember the definition of cyclical unemployment. Is really going to help you. Okay, now which one of these is cyclical unemployment? Is it A, B, C, or D? I think you guys might be right on this one. It's D. Recession in the building industry. Okay. Now, read the description. Recession is part of the business cycle. Demand for output and jobs fall, unemployment rises until recovery is underway. The first is an example of frictional unemployment that we just discussed earlier. Second is seasonal, and third is technological unemployment. So that basically leaves D as the cyclical unemployment. Okay? Because if you look at the definition of cyclical unemployment, it means overall through the business cycle. If you're experiencing a growth or a boom, you guys through the economic cycle, people are going to be either being unemployed or employed, right? If an economy is going through growth and boom, high employment, and if it's going through a recession or a slump, so high unemployment. Let's move ahead. Now, this is the best question that I have so far. Okay? Now, this question is really going to test all that you've learned. Now, don't be intimidated by the size of this question. Okay? Break it down. Whenever you see any question, always break it down. Okay? Okay, there are 4 countries: Northland, Southland, Eastland, and Westland. And some statistics have been provided. Okay? Those statistics are a change in GDP, means economic growth, balance of payments, change in consumer prices, meaning inflation, and change in working population, meaning unemployment. Okay? So, it's showing you how much a country has grown economically, how much economic growth these countries have experienced, how much balance of payments they have, right? Whether it's positive, negative, how much inflation it has, how much the prices have increased over the years, and how many people are employed or unemployed. Okay? Now, which country has experienced stagflation in the relevant period? Now, stagflation means high unemployment and high inflation, right? High unemployment combined with high inflation. Okay? Which of the countries is it? Guys, take 5 minutes. Okay, it's a big question. Take 5 minutes and let me know the answer. Okay, I hope you guys have understood. Tell me, is it Northland, Southland, Eastland, or Westland that has experienced stagflation? Ready for the answer? It's Northland. Okay. Why? Just take a look at the stats. Okay? In Northland, what's happening? Northland has a very high inflation, right? 27.5% the prices have increased, right? And it has also the lowest amount of unemployment. Okay? But people can argue, what about Westland? Westland also has high prices, right? And unemployment. Yes, but Northland has a much higher amount of inflation. Okay? Yes, it has less unemployment as compared to Westland, but the prices are so much higher. Okay? 2% versus 27% almost. Okay? It's a lot higher. And that humongous increase in price basically nullifies any unemployment benefit that Westland might be having. You know, in relation to the answer, of course. Okay? So Northland becomes your answer. Okay? Guys, the explanation is in front of you. Please go through it. I have explained it the best I could. Right? So, this was the last question, ladies and gentlemen. I really hope that you guys enjoyed this lecture. Our 3rd chapter, microeconomic factors, have finished today. And from the next class, we'll be starting with a very interesting chapter, chapter number 4, microeconomic factors, right? So, with that being said, I'll take my leave. Thank you so much, guys, for listening in. And please revise the concepts, revise from the notes, revise from the study text, attempt the kits down, the VP and the Kaplan kits, okay? And I'll see you guys in the next class. Take care. Goodbye.